money is a tool, right?
Yeah.
It can take you where you want to go,
Exactly.
but it will never replace you as the driver. At the end of the day, you have to learn how to use a tool. Welcome to the Smarter Tomorrow podcast. I am your host, Susan Wanjiku. Today we are going to be having a conversation around smart investment moves, and I am joined by Terry Muhoro, a financial advisor. Hi Terry, welcome to our podcast today. I'm very happy to have you here.
Thank you.
I'm really excited for our conversation.
Thank you. Thank you,
Maybe
Susan.
we can start with a bit of introduction. Please tell us a bit about yourself and what you do.
Okay. So thanks for having me. My name is Terry Muhoro. I am a financial advisor. I have been a financial advisor the last over 20 years. One of the things that I major on is personal financial planning. With individuals, we look at how we can be able to enable dreams, open up conversations around planning and making sure that people make the best of what they are earning today, so that then in that future, they're able to be financially independent. So it's basically the whole financial journey from when they start working to when they retire. How then do we map up that journey so that we have the best journey ever?
Yeah.
Yes.
You've done this for over 20 years.
Absolutely.
You've probably seen it all.
Yes,
You've probably seen
yes,
it all.
I have.
What is, what do you think of our investment behavior or decorum as Kenyans? Seeing as I bet you've worked with majority of Kenyans in the past. I mean, your target market is the Kenyan market?
Yes, the Kenyan market.
How are we doing with regards to investing?
Yeah, and we have different types of investors in this country. We have people who believe in spending, you know, and not saving anything. We have savers, people who are only looking to, literally hoard everything that they are earning. But one general outlook of the Kenyan investor is that everybody is running to look at investments and running for the returns that are there, and not realizing that you do not just run for the returns, but you also need to look at the risk that is there. And that's why you have seen very many Kenyans have lost money with Ponzi schemes, with, maybe stock market. Just when there's a run, then that is the time when people are buying. You buy the stocks when they're high, and then you want to sell when the market has gone down. So you find that the outlook of the Kenyan investor is what is the highest return that I can be able to get. But that is not it. We need to look at a holistic perspective of investment. And as you save your money, you don't save or invest your money to lose. You must look at how can I best make the best of what I am putting in.
Putting my money to work for me, right? Sending every coin to work. I find that very interesting because, I mean, I am a personal finance coach myself. I work with people on a one-on-one basis, and I really do agree with you when you mention we are return chasers. And I think for me, one of the things that I've realized with quite a number of people getting into investing, and even when they're asking, coach, which investment do you recommend? Then, definitely you'll probably mention a few, and the first question is how much money can I make and in how long? And I've always felt like a better question would probably be before how much money can I make and by when is would this investment work for me as an individual, right? Speaking about goal-based investing, right? For me, I always tell people, I don't know about you, but like investing for me is about, like, it's informed by my goals, not just the return that I'm going to make, or whether everyone else is investing in this thing in the market, but like looking at it from a very, like, I don't recommend separating investing from life. So I'm looking at investments. I'll consider my age. Am I young? Do I, am I old? Am I towards retirement? I look at, do I have a family? When do I plan to retire? Are there special considerations I need to make around like my lifestyle? And like all of these things alongside like how much money I do have in terms of disposable income, then all of those things, inform my investment decisions. I love that you've put it in a way that's powerful, holistic. A holistic view, You talked about people that are savers, spenders, all that. For you, what's the biggest difference when someone asks you between saving and investing? What's the biggest difference?
So when you're looking at savings, savings is basically that putting that money away as you earn it every month. Most of us are, you have a salary or you have whatever income that comes at the end of every month. Those in business, you have that check that comes maybe every so often. Savings is basically getting part of that money and putting it into a safe haven, where you can probably use that pot for your daily use. You can use it for your investments. You can use it for that. But then you have to have a place where you push away money from your expenses. So that is savings. When we are looking at investment, is you put in money with the aim of growing that money, all right? With the aim of getting a return from that investment. And when you're putting money in an investment, it is not just about the money, but we also need to look at the duration. You also need to invest time, not just the money. You also need to invest discipline, not just the money. Because when you're looking at the financial discipline, you cannot put in money in a long-term plan and you want to access it after a year. You are bound to lose your money.
I'm withdrawing my retirement fund 2 years after I opened the account.
Exactly. So you have started probably putting money for a pension, for example, or for your retirement. But you want, the minute you move from one employer to the next, you want to get that money and put it into something else, And in most cases, when you remove money that is not very well planned for, you don't see where that money goes.
That's true.
So even as we look at how to save our money, we must also be very deliberate in the choices of investments that we make. Where will be, my short-term investment be put in? Where will my mid-term investments be put in? Where will my long-term investments be put in? And that also, as you mentioned, it must be goal-centered. All right.
You can't be a good investor if you're not setting your goals right.
Absolutely.
Because we are doing goal-based investing.
Absolutely. Absolutely.
I hear you. For me, saving is very simple. Like saving for me is capital preservation, while investing is capital multiplication.
Exactly.
It's more of like, fine, I'm saving money, that's just for my short-term needs, maybe school fees here and there. But like when I think investing, I think long-term, right? I think wealth building, wealth creation, wealth multiplication. Obviously, being a financial advisor, you get this question a lot. So I'm definitely going to put you on the spotlight today. Do you have a favorite investment? When you think about, of course, because I want us to talk today about money market funds and bills and the stock market. Before we like demystify all of these investments, right? And today I want us to do it very simply and in a layman's way, like where we can truly understand when we say a money market fund, what do we mean? What is a treasury bill and bond? How does it work? But I want to put you on the spotlight. Do you have a favorite?
I have a favorite, but my favorite will depend on what is the goal that I am putting that money in. Money market is fantastic. You put in money today, maybe for a holiday in December, all right? Or for school fees in January, because school fees is coming. So you don't leave money just lying in the bank account. Put it there. The beauty about money market is the fact that your money is growing on a daily basis. So as you sleep at night, that shilling that you put has earned some cents, all right? And that's a fantastic thing because then it is not money that is in your pocket, but it is in a safe haven where you know you cannot just wake up and find that everything is gone, you know? So money market is my favorite as far as my short-term investments are concerned or where I put in money for the short term. For the medium term and the long term, then it varies. I mean, there are bonds, there are long-term savings that are sold in insurance companies where you can be able to discipline yourself. Again, when you're looking at where to put money, especially for the long term, you may not have the millions today, but you can build your savings. You can build your investments on a monthly, on a yearly, on a, on a quarterly basis to build a fund for the long term. So how do you do that? You need to have the discipline to do it. If you don't have the discipline, then you have to force yourself to get there. So you don't put in money where you know you can access it tomorrow. Put it in a long-term savings that will probably earn you that good return in the long run, but it also restricts your withdrawals.
Yeah, withdrawal.
Because you need to be whipped to the reality of you not being a good saver or being a good investor.
Yeah, I hear you.
Yes,
for me, my favorite also, interestingly, in the short term is definitely the money market funds. And for me, it's because like when I started my own personal investment journey, I started investing, again, you've mentioned whipped.
Yes.
I got whipped.
Yes.
So I was working myself in an investment company. You have access to all of this information. You're managing money for clients, and I lost my job.
Yeah.
And you would think that because I'm exposed, I'm in that environment, I would have ideally reflected this information and this knowledge to my own personal finances.
Exactly.
And that wasn't what happened, right? So like for me, I started my investment journey and putting money aside in a money market fund. And why I love money market funds is because absolutely no one is locked out. That's why they're my favorite kinds of investments. Because when I started mine, I started with as little as 500 shillings. So at that time, I'm trying to figure myself out. I'm jobless. I'm freelancing. Whatever job comes here and there. I'm trying to think, where can I save my money? Where can I invest my money? Right? And I love that we've already talked about like the difference between saving and investing. Because saving is capital preservation, as we've just said, and investing is capital multiplication. Now, the day that I started thinking about capital multiplication, and I stopped looking at it from the standpoint of I need to be a rich person to invest. Was when I understood the issue around inflation and compound interest. So I love to give this example because it was given to me. We have person A who puts their money, does not invest their money. They primarily save their money in a current bank account. And then we have a person B who probably is a bit more exposed and they have a money, let's say a fixed deposit account, a savings account. And then we have a person C who has a money market fund. They are woke. They know these things, you know. Now let's place inflation at, say, I don't know, 8%. Now, if I have my money seated in a bank account and I now factor in an inflation of 8% per annum,
you're losing money.
Exactly. But then you see, most of us do not understand that because we know what inflation means for us as consumers. Obviously, when I go to the supermarket, mkate imepanda, I'm like, oh inflation. But like as a saver, as an investor, when I've understood what inflation does to my savings and to the purchasing power of my money, I stopped waiting to get rich to invest. Right? Because you see, 8% inflation ideally means that rather, the purchasing power of my money has depreciated by 8%. So if it's in a bank, I've earned 0 interest, but the cost of living has gone up by 8%.
So you continue losing.
So I'm -8 poorer at the end of the year. If I'm in a, let's say, like a typical fixed deposit account that's probably giving me 5 or 6%, yes, I'm getting an interest, 6%, but it's lower than the inflation rate. So I'm still like at a -2 in terms of the value of my money. So why I say money market funds are one of my favorite avenues to invest as like a low-income earner is because I'm able to kind of like keep up with inflation because most of them will give you a 9% return. So even with inflation at 8%, I've been I've been supplemented for inflation, but then I've slightly beat inflation by like 1%.
You have earned something.
Yeah, and realizing that I can do that with 500 bob, 1,000 bob, 5,000, whatever is accessible to me, that was really amazing for me. So if I asked you, if you were to define for us, I know you do financial advisory, what is a money market fund? Because we are talking about them, maybe the people listening to us do not really understand. Very simply and quickly, what would you define a money market fund as?
So probably before I define what a money market is, I want to just probably build on to what you have said. One of the things that I tell everybody that I meet, everybody has capacity to save. What we don't have is the discipline or the know-how of where we can be able to put the money that we are saving. So it is important that we keep educating as many people as possible, and that is fantastic. So in looking at what money market is basically where we invest in short-term instruments, okay? So you will go to an institution, for example. Money markets are in literally almost all the banks today.
Yeah.
All right? And what the banks will do is that, or what that institution will do, like Old Mutual, for example, will take your money. They put the money in short-term instruments, treasury bills, fixed deposits, call deposits, but then it is a collective investment.
Yeah.
Where you come in with your 500 shillings, I come in with my 200 shillings.
Yeah.
The other person brings in 1,000. There is one who has more money, will bring us 10 million shillings. So we put that money in a pool of funds.
Yeah.
And we look at where would we best get a good return and mitigate on the risk that we are hedging this money on.
Yeah.
So if we put money in, say, for example, a 91-day T-bill, then we know for sure after 91 days, we have gotten a return of 14%, you know, per annum from that money that we have invested in.
Yeah.
If we go to a bank like, say, you know, any other big bank, small bank, and tell them, you want money, most banks will actually have call deposits where they will need money overnight cash or, you know, money for a short duration. So we lend money to institutions like that, but we dictate the rate and say, we'll give you, yes, that 100 million, 200 million, but we will...
You negotiate.
Yes, we
Mwenye pesa ndio kusema.
You know, cash is king.
Yeah.
Cash is king, my friend. So when you have the cash, you can be able to negotiate and get a good rate.
Yeah.
So you who is coming under that institution, basically you're benefiting, leveraging on that good return they are getting.
That's true.
And at the same time, you minimize your risk.
That's true.
To bare bone.
Yeah.
You know, where you know for sure that if this institution goes down, there is a custodian behind the scenes. There is, you know.
Yeah, the regulator.
The regulator behind the scenes. So at the end of the day, you have actually mitigated your risk. You have reduced your risk to a good level.
Yeah, it's why, I think for me, that's why I was very comfortable, because I was also very risk averse.
Exactly.
I did not know like anything beyond, like, of course, until I started like working in investment and started to realize, oh, beyond banks, there are other options, say, for example, that I can invest, right? Those are money market funds. What about treasury bills and bonds? Actually, that's another one of my very favorite avenues to invest money. With bills, you can do, as you know, as such a short duration, 91 days, 364 if you want, and the bonds. So, I mean, what do you think about T-bills and T-bonds as an investment avenue?
They are fantastic.
Yeah.
They are fantastic. What I normally advise is, even as you look at investment, you must also spread your investments.
Diversify.
And diversify your investments. So that then you're not only holding money in one instrument.
That's true.
All right?
Yeah.
So treasury bills, treasury bonds are basically government borrowings where probably there is infrastructure that needs to be built. So the government comes to the public and floats a bill and says, in the next 91 days, we will give you a return of this much. So it's basically getting money from you and me to participate in the government projects. And then we get a return based on that. Treasury bonds, so treasury bills will be 91 day, 182 days.
Short term.
Yes, very short term, and 360. Basically, the longest for a T-bill is a year.
1 year,
All right? For treasury bonds, on the other hand, they are a bit longer. In fact, it is just in the recent past that we have seen the government floating bonds for 2 years and 5 years. No, for the longest, it has been 15-year, 20-year, 25-year bonds, where you lend your money to the government, and the minimum for a treasury bond is 100,000. And the other day, the central bank launched
the new app.
So you don't even need to go to central bank anymore. You know, before you would have to go to central bank, you apply,
napanga
line there. You know, but now with the new app, you can be able to download it. You get an account, and you're able to transfer money from your bank account into your CDS at central bank. So the bonds are basically a bit longer in terms of the tenure of the investment. So you don't get into a bond today and you want out at the end of the year. You will have to sell it at a discounted rate. And that means whatever it is that you aspire to get as a return, you will not be able to realize it. So it's important, as I said, diversify. Money market is one thing, because the beauty about money market, it's money on call.
Liquid.
You can get money in today, get it out tomorrow. Most of the asset managers of money market have put a USSD where you can be able to just, withdraw the money if there is that need, okay?
Yeah.
Treasury bills, on the other hand, again, they are a bit, when you look at periods with comparing to money market, then bills will be slightly longer, because if it is a 91-day, you cannot put money that you want to spend next month to pay rent in a treasury bill.
Exactly. Yeah.
All right?
Yeah.
That money sits in a money market. You cannot put money that you want to pay school fees with in January in a bond.
5-year bond.
Exactly. In a 5-year bond.
Yeah.
But the beauty about bonds is that you get the interest, which we call coupon, every 6 months.
Yeah.
So you'll buy a bond for maybe giving a coupon of 14%. The latest was, I think, 17.8 or thereabouts. Very good returns.
Yeah.
So you will get your coupon every 6 months. So you buy a bond in the month of September. Next year, is it February, you will get your interest. It's sent directly to your account. Then 6 months later, you get your interest sent to your account. So every 6 months, there's money coming passively. Yes, coming in passively. And it is a very good way of investing when you have the lump sum. Because again, when you put in just maybe a mere 100,000, what does that mean for you in terms of return?
Yeah.
When that coupon is paid, how much interest is it? Will it make much of a difference as far as your investments are concerned?
Exactly. Yeah. And I love that you're raising that, because like for me, I love to do investing from the perspective of attaching a purpose to this investment.
Absolutely.
Because when you do, you will look at those things you're mentioning, timelines. How much is this return? What how big of a
portion
difference
of your money,
exactly is it going to make? Because like for me, a favorite thing I like to do is I'm like, if this is my investment, then I want to attach a purpose to it.
Yeah.
So for instance, money market funds. They are liquid, accessible. You can top up anytime, withdraw anytime. So I attach the purposes of things like my personal emergency fund.
Yes.
I put it in a money market fund. Sinking funds, like a sinking fund is just like, the usual accounts, maybe a school fees sinking fund, a travel sinking fund, a Christmas sinking fund for the family. Because it's easy to top up, easy to withdraw.
Sure.
When I think of treasury bills, I think of short-term capital preservation. As you mentioned, I had you mention discipline, and I know that some people struggle with discipline. You'd find, once I lock my money in a treasury bill for 91 days,
then it is there.
It has to stay there for 91 days or 364. So I look at it in terms of like, maybe I've done a job, a tender, I'm yet to kind of like decide what I want to do with this money. I don't want to leave it somewhere accessible, but I also don't want to put it in there for a very long time. So I preserve it maybe for like 91 days, 182 days. It's like for short-term capital preservation of money that is intended to be used in the next 6 months, but you don't want it to be accessible, right? And then treasury bonds, my favorite, passive income. Like just making money in my sleep, and it's really, really interesting that you spoke about like how much money should go to like a treasury bond, for instance, thinking about the coupons. If I just put in the 100,000, of course I'm getting maybe 6,000 every 6 months, right? So there's a strategy I like to teach my clients. Of course, when you look at it from the standpoint of like you have 100,000 and then you invest, of course you're getting the 6,000. It may or may not be impactful depending on what you want to do with the money. Because like if I got it today, I'm paying internet. For that 1 month, for that 1 month, for that 1 month, and maybe steamer, but then you see, I learned a strategy called lagering of bonds, where yes, you can have the 1 million, but then say I get one bond that pays me in January, and another one that pays me in June. If I get cash flow again, maybe like a windfall amount, I get another one that pays me in February and in August. And I can actually accumulate, whether it's that it can be even over a 5-year period. In fact, that's one of the strategies I'm currently working on. Because sometimes you're a low income, Anna, you don't have millions, but you have 100K, you have 200, you have 250. So like layering those bonds, because I learned that if you can actually build up to 6 bonds, you can create passive income for 12 months.
For 12 months.
Of the year.
Yeah.
How fascinating is that?
Absolutely.
You know, I was like, anyone can access passive income. I guess it's just our mindset and whether you're willing to kind of like give yourself that room.
Yes.
5-year period to build up bonds that can pay you income
over
I mean 12 months in a year. What do you think about stock market investing, especially like right now?
It's on the floor.
You tell me, are you investing?
Oh yes, you know, anyone who has been in this market for a while, we have bought IPOs. You know, we have bought stocks. You know, when the market is running. You know, for sure, stock market is not for the faint-hearted.
It isn't.
It is not for people who are risk averse and they are thinking, I will get a heart attack the next minute.
It's the easiest way to get blood pressure.
Thank you.
It is the easiest way to get blood pressure.
And you do not invest money in stock market that you want to use in the next 1, 2, 3 years.
Anytime soon.
Because you have to invest your time as well.
Yeah.
If you put in money in stock market that you want to get out next year, be ready to start taking pressure meds.
Pressure meds.
For sure. You have to look for pressure meds.
Yeah.
Because you don't know what will happen. You know, the stock market tanks. Just when you think it's going to go up, it tanks again.
Yeah.
But the volatility of the stock market, in the long run, when you're investing for the long term, it gives you the best returns.
Yeah.
I will give you an example of Safaricom at IPO. We bought Safaricom at 5 shillings.
Like 5 bob, yeah.
All right? Before a year was over, it was at 2 shillings and 80 cents.
And guys sold a lot.
And you're thinking, what do you mean?
Yeah.
Where is my money?
Yeah.
This thing is going to go to zero. So what do? You offload. But a wise investor would buy at that point.
Yeah.
All right? Safaricom has gone up and down and up and down. Now it is down. At some point, about a year and a half ago, Safaricom was at 38 shillings.
They hit an all-time high of 44
Thank you.
bob last year, but one,
Yes. But today, where is Safaricom?
16.
At 16 shillings.
Yeah.
But that person who bought at IPO about 12 years ago, are they in losses?
No, not
They're
at
not
all.
in losses.
Yeah.
And that's why I'm saying stock market is not and cannot be your short-term investment. And it is not just Safaricom. Look at even banks like KCB and Equity that have actually been doing pretty well. And they are quite stable, you know, as far as their performance is concerned. But the growth cannot be you're expecting to make 100% overnight. You have to invest your time in stock market.
Yeah.
They are very good when you're looking at, you know, probably when you're expecting your firstborn and you're thinking, campus money. You can put it there.
I know.
And it will actually grow and you'll be able to pay campus from stock market. I have seen people who have grown their wealth in stock market. But you need to be very aware of the performance of the market. If you're basically investing in the stock market as a speculative investor, then you need to have your ears and eyes on the ground for you to actually make money. People have made wealth out of the stock market, but there are also families who have actually
lost all their money. And that's the thing that I think for me, I had to learn really early. I'm currently like a baby in the stock market. I'm on my 3rd year. And like for me, one of the things that I had to make peace with is the short-term fluctuations. You can't be reactive.
You can't.
With the stock market, right? Like when the prices are low, you're running to buy. When the prices are high, you're running to sell.
You can't.
Yeah, you need to realize that you have to actually decide on what strategy you would like to use from the word go. Because then I do know that there are people who do, like for me, I divide it into like 2 different strategies. Growth investing, dividend investing. Growth investing is like trading, where you buy low, sell high. And like as a personal finance coach, I always discourage anyone who has no training in market analysis because there's a very fine line between trading and gambling. So sometimes people ask me, Coach Susan, what is the difference between gambling and, you know, this stock market investing? Because one moment it's up, the other moment it's down. And for me, the biggest difference between gambling and trading is that gambling is not data backed. There's no information that is telling me Manchester will win today. I'm just guessing.
Exactly.
And there's no data that will prove me otherwise until after the game has been played.
Thank you.
But investing is data backed. I'm looking at trends. I'm looking at news. I'm looking at fundamental analysis, right? So that I can be able to get like, you know, my decision is informed. And then of course, dividend investing, which is my fave. And that's what I'm doing. It's more long term.
Yes.
I love that you mentioned if you have a 1-year-old and you want to plan for, say, 20 years from now when they're joining uni or 18 years from now, it's a good like investment. Because you see, I joke around with my clients and I tell them, dividend investing for me is like choosing a marriage partner. You don't wake up one day and meet a guy.
It's this one.
I'm marrying you. Like we've just gone on a date, umeni bamba. Now, like you know, I'm married. Well, I do hear Gen Zs are doing that. But generally, you want to date this person more. You want to learn. Yeah, you want to learn how do they behave when they're broke? How are they when they're angry? You know, what are their values, etc. And because of all this information, then you decide, I'm going to marry this person.
With an informed decision.
Yeah, and I'm going to spend the rest of my life with them. When I'm choosing my shares, I want to know everything about this company, the financial health of the company, innovation strategy, growth strategy, what is their value proposition in the next, you know, 5, even 10, 15 years
to come.
That way I'm able to decide that in this moment right now, I'm going to start doing a little at a time to buy this, you know, share X or share Y and grow with it, right? So I think shares and stock market investing it's something that you really need to be aware about strategies. And can I tell you something interesting I learned?
Yes.
Warren Buffett. Who doesn't know Warren Buffett?
He's
like a stock market god. So everyone talks about like how good of a stock market investor he is. And obviously he's been able to become like a dollar billionaire with stocks. I read something interesting about this guy. Warren apparently started investing in the stock market at age 11. Wow. Did you know that?
Wow.
And I'm like, wait, what? I read that in The Psychology of Money. There's a book called The Psychology of Money. And everyone highlights how great of an investor he is, but people don't talk about when he started. So on top
how much time he has invested.
Thank you.
In that market.
So you see, this guy obviously knew what he was doing, but then time was on his side. Compound interest was on his side, which is why he's been able. So I do agree with you. Stock market investing, definitely not a short-term gig.
And again, when you're looking at stock market or that long-term investment, you must analyze. I mean, you must look at yourself. This is very, very personal. Because then you cannot start risking your money when you have just gotten out of employment. Not at retirement.
You're coming for us today.
It's true. It's true. You need to conserve whatever it is that you have accumulated. So part of financial journey, the first pillar of financial planning is your growth and accumulation stage.
I love that.
Okay? So you have to find a place where you're accumulating. And part of accumulation is when you look at stock market, when you're young. Not when you are in your 60s. You know,
almost retiring.
And then you hear, oh, you know, people make millions in stock market, and you run and dump your pension there.
Oh, dear God. Don't say pension.
Then it goes down. Then, lo and behold, for sure, blood pressure is your portion. So age is very, very important as you look at your investments and, and where you need to put in your money. Your risk appetite as well. Because you can be young, but then you cannot imagine losing your money. There are people who are young and and those are the ones I was calling savers. Savers are hoarders of money.
Risk averse.
I do not want to lack sleep because I put in a shilling there and today it looks like it's going to be 90 cents. You know? So also the kind of an investor you are is very, very important. And that's why it needs to be personal. It needs to be you as an individual. What do you view as, you know, risk for you? What do you view as a way I can be able to invest my money?
I was a hoarder. I was that person until one of my mentors called me out. He told me, Susan, you're afraid of losing money. That's why you're not investing. Do you realize you are already losing money to inflation? But not like either way you're losing. And I love that you're raising a risk issue because do you believe there's such a thing as a risk-free investment for people who are hoarders, savers, risk-averse?
No. There is a risk to everything. Even you sitting here, there's a risk.
Right?
Yeah. Yeah.
A light could fall on me just now.
Thank you. I mean, life is about risk, but also it's about taking calculated risks depending on where you are in life.
Yeah.
All right? Even that money market, that treasury bill, that bond, we have seen what has happened in Ghana.
Yeah.
You know, the government defaulting on sovereign debt. That has happened.
Yeah.
So it is not outside of losing your money. You know. So it is very, very possible that wherever you put in money, there will be risk.
Yeah.
But as you actually put that money in, look at yourself, all right? So there is risk in everything.
Yeah.
But where are you putting what money? Yeah? Is the money that you're putting in here today short-term money, but you want to risk it to the highest risk? All right? Are you exposing the highest risk to short-term money or to the long-term money? Because the beauty about long-term, as I said, when you're putting money in stock market, very high risk, but again, very high return.
Exactly, in the long run.
In the long run. So you put in money today for the long term, you will have peace of mind that despite the volatility, you will be able to make a return on your money. Okay?
Yeah.
So there is a risk around everything.
Everywhere.
There is a risk around everything.
So we cannot let that deter us from putting our money to work for us.
Absolutely.
Yeah.
And that's why you need to plan your short-term, medium-term, and long-term
goals.
Because then that dictates what money goes where.
Yeah.
Yes.
Yeah. And that's one of the things that I learned very earlier on in my journey to divide my investments into time horizons, right? Yeah. Short-term goals. What are the investments to align to this? Long-term goals. What are the investments to align to that? And then, you know, medium-term goals. What are some of the investments to align to that? And I think that is very helpful, even as people are doing financial planning. To literally match their investment choices to their life goals.
Yes.
And in other words, what do I want in the next 10 to 15 years? How much will it cost me? By when do I need it? And now while choosing savings and investment options, aligning your choices to that particular. Like
so how much goes where?
Yeah, how much should go where? I love that. Can we talk about diversification? Because obviously there's quite a lot of information overload, if you ask me. We have all these things we've talked about, money market funds, we have bonds, we have bills. I mean, we've not even scratched the surface of things like offshore investments. Exactly. And now I'm really loving the Kenyan space right now because as a Kenyan, I have opportunities to invest in index funds, the S&P 500, to open dollar-denominated accounts or euro just to preserve and protect my money from capital depreciation. How would you advise people to, like, if I have all these options and I want to understand, like, how can I best on a very simple way diversify my investments? First of all, tell us what is the power of diversification when it comes to investing, and what is a simple strategy someone can use to ensure they've spread out their risk well?
So diversification basically is ensuring that you don't have all your money in one basket. All right? You ensure that you have a variety, an array of solutions for your money, right? And there is money that can be put in a bank account. There is money that can be put in that offshore account. But most important, and this is what I tell my clients, you don't invest in the dark. You cannot afford to invest in the dark. Yes, the stock markets out there are doing well. New York stock market is doing pretty well. But what do you know about it? Have you gotten, as you said, have you gotten proper information around that investment that you want to put your money in?
So educate yourself first.
Exactly. Before you can decide, this is what will go here. Can you get proper information? All right? And do not fear calling out some investments that don't make sense. You know? You must be aware that, you know, even as financial advisors, there are some of us who are very selfish as far as what we recommend to our customers. And you must be aware that at the end of the day, ultimately, this is your money, and this money must work for you.
So take charge.
Take charge of your money. Take charge of your money and take charge of your decisions. And how can you take charge when you have no information? So don't just rely on the hearsay. Do your own investigation.
Yeah.
You know? As you diversify and put that money in that money market. How many money market funds do we have in this country?
Over 15.
Exactly. Yeah? So when you're reading, one is giving a return of 18%. What risk?
Question. Yeah.
What risk? And also compare with what is it that is in the current money market.
Or what is like the average return.
Exactly.
Yeah.
Why is the T-bill giving a return of 10%, but this money market will give me a return of 18%?
It doesn't add
up. And they are
up.
saying it is a money market.
It doesn't add up.
You understand?
Yeah.
So that's why I'm saying you have to take charge of your money and have the knowledge yourself. Look at what exactly is out there. Even as you diversify, and it is very, very important to diversify because as we said, you cannot just put money in one basket.
One basket.
Spread across various investments,
Yeah.
but at the same time with knowledge.
Wow, I love that. I keep telling my clients, an investment in education will pay you the best return. Forever and ever, because no one can take that away from us. And that's one of the things that I wish more and more people can expose themselves to. It makes me very sad that our education system has not taught us these things. So like you go through school, you're encouraged to get good grades, get a good job so that you can earn this money. But no one teaches you how to steward the money. Like you want to get the bag and we are working 15-hour days to get this bag, but securing it
is a different story.
Is a whole other different story. And I love that you've said, take charge, learn, expose yourself, educate yourself. And there's quite a number of resources. This podcast is all about like helping us make smarter, decisions. There's content on YouTube. There is content online on Google. And I always tell people, invest in financial literacy and invest in understanding these things for yourself because that will make you the best return forever. Right? Because no one will come tell you things and lie to you. You will understand risk versus return, right? You will understand, okay, now someone will even just come sell you something and you're like, no, this does not. This doesn't make sense.
Because you have the know-how.
Yeah, you have the knowledge, right? For me, diversifying has always been like a very simple portfolio. I don't know what you think about this, but like a simple portfolio for me would look like very practical one. A money market fund for my short-term needs. Say maybe even bonds or a bond fund and a unit trust for my medium term and like a pension fund for my long term, maybe retirement, like on a very basic level, or maybe even like a money market fund for the short term, bonds for the medium term, and then maybe stocks for the long term, right? I love that, man. We need to wrap this up. And I think I'd want to pick like maybe your top 3 recommendations when someone is trying to work on investing and wanting to become an investor for the long term. What are some of the considerations we should make?
I think one of the most important thing as one looks at investment is what duration do they have? What time do you have to invest where you're investing? Okay. At what point in your life are you starting that investment? It is very, very important. I always say that as soon as you get your first paycheck, you must have a plan of, even if your first paycheck is 10 shillings.
Yes.
Please put aside 10 cents.
Have a plan.
Have a plan. Have a plan. Because that 10 cents today over the long term. And you see, when you start working probably at 24, 25, you have, your whole life ahead of you. So the power of compounding over the years will actually grow for you your money. So one of the most important things to look at is time. The other thing that you need to look at is your risk appetite. Okay? Are you, much as we have talked about risk here, at the end of the day, when you sit alone somewhere and yes, you are convinced to put money in a high risk investment, does it give you the chills? Yeah? Do you have sleepless nights? So it is important to actually understand yourself and know that, yes, I can risk my money, but what proportion of my money can I actually expose to what amount of risk? All right? The other thing is, as we have said, educate yourself. Educate yourself. Don't delegate that information to somebody else.
That's powerful.
It is a personal responsibility.
Yeah.
The same way, when you go to work, you're given a job description.
Yeah.
It is your personal responsibility how you grow your money, how you work around your money. You know, to the point of you need to do your proper budgeting. You need to know the kind of loans or debt that you're getting yourself into. Yeah? Because we have seen, I mean, the truth of the matter is debt can cripple you.
It is.
And when you have loud debt, you cannot be an investor.
That's true.
It is very, very difficult.
Yeah.
So very important as you look at your budgeting, your debt management, have that responsibility. Don't just sign on that dotted line because you have been told you have qualified for a loan of 5 million shillings. Can you actually afford it?
Yeah.
You know?
Yeah.
It is about taking on debt that you can afford, not what you can qualify. You know? And in the times that we are living in, you look at the amount of apps that are willing to give you money and SMSs that you get on your phone.
It's like they know. It's like they always know. Yeah. Like you have money in your account and all of a sudden, you know, I mean, you don't have money in your account, we can give you more. Or even when you're very broke, the messages are even more.
Exactly.
So looking at your own personal finance habits.
Yes.
I love that.
Your
so
spending habits, yes.
Yeah. So what I'm learning from you, look at the time horizon.
Yes.
Can I make what I want to make in this investment, or should I leave it longer, right? Where am I in my life right now?
Yes.
Like which stage am I? Should I be doing this investment in my 60s?
Yeah.
Should I be embracing this kind of an investment in my 20s? I've also had you mention, I mean, I love that you've raised the topic of budgeting.
Yeah.
And personal finance habits, because I keep telling people that money is a tool, right?
Yeah.
It can take you where you want to go, but it will never replace you as the driver. At the end of the day, you have to learn how to use a tool. If I gave a child this iPhone, they can't, I mean, and they don't know the value of it or how to use it, how to best maximize on its potential. It's pretty much like a toy.
Yeah.
Right?
They will only play games.
They will only play games. So they've not maximized. And that's the thing. Most of us are not maximizing on our earning potential. Yes, the money is coming in. You don't understand how to preserve it. You don't understand how to grow and multiply it. And the only way to do that, because we didn't learn that in school, is to actually do what you said. Take charge. Take control, invest in your own education. And I love that you say, don't delegate.
Don't delegate it.
Don't delegate it to someone else.
It's personal responsibility.
I love it because it's personal finance, man.
It's personal finance.
I love all the insights you've shared with us today. Yes. I do love talking about personal finance. And you know, as you've said, it's personal. So we are bringing it down to like an individual level and understanding ourselves. Thank you so much, Terry.
Thank you,
I'd like to take your parting shot. What would you like to leave us with as a financial advisor who's worked with Kenyans over 20 years? Give us your, a word of wisdom that we can remain with and ponder upon. So I think one of the most important thing is, even as we discuss about financial planning, it is important that you listen and you action on it. So it's not just about taking down those notes. At the end of the day, take action and take action now. Wow. Thank you so much. As you guys have heard, application makes all the difference all the time. Thank you so much for joining us on this episode. We hope that you have learned. We hope that you've gathered some insights that you can start applying. I hope if you have any questions, please reach out to us so that we can help you and guide you to understand your role in your own personal finance journey. Thank you again for joining us, and I will see you on the next episode of the Smarter Tomorrow podcast.